Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Mike Loukas, CEO and Principal of TrueMark Investments, to discuss the major drivers of demand for structured outcome investing today. Michael, welcome to Trade Talks.
Good to be here. Thanks for having me, Jill.
All right, and let's first learn what structured outcome investing is, and then tell us about the major drivers of demand.
Well, structured outcome investing is, I think, a growing segment in the equity space right now, and you hear a few different terms to describe it. One would be defined outcome, one could be structured outcome. I like to call it predicted outcome, because it's certainly, there are some aspects of it that are certainly not hard hedges, but in general, what it is a volatility management tool for portfolio construction. And by volatility management, what I mean is, generally speaking, these include some sort of a downside mitigation or downside buffer, and then varying degrees of upside capture, some capped, some uncapped. And but what you'll find across the board with most of these tools is a built-in downside buffer or mitigation that can help reduce downside exposure or manage volatility for investors for a variety of reasons. And I think certainly the last 4 to 5 months, we've seen those reasons come back to the surface pretty strongly.
And so, Michael, let's discuss that. How has the COVID-19 pandemic changed the way that investors approach asset allocation and strategy selection?
Well, I think it's changed it in a couple of significant ways. One is emotional. And as we know, the emotional reaction of most investors is typically the opposite of what we'd like them to do from a professional asset management standpoint. So volatility management can help remove the emotions from the equation to a certain extent. And then also what the pandemic has given us is an extremely low rate environment. And in low rate environments, as we know, people will struggle to find alternatives to equity allocation to gain any kind of return from the marketplace. And what a structured outcome approach can deliver is the ability to maintain that equity exposure or put cash to work in low rate environments without assuming 100% volatility of the equity markets. So I think the pandemic and that type of instance has given us two fundamental reasons why these products make sense now.
What are the drawbacks that are inherent to the first generation of structured outcome ETFs?
Well, it's interesting, because we often encapsulate these types of investments in positives and negatives or drawbacks and benefits. I see them all as really effective tools that can be deployed differently. And the first generation of structured outcome or defined outcome ETFs, while it provides some great options, certainly liquidity is something that's vastly important. Transparency is fantastic. No credit risk like a traditional structured note. Those are all fantastic qualities. Obviously, a downside buffer is something we see as a very important characteristic. But when it comes to upside events, and when we look at volatility management, we'll often classify it as left tail or right tail events when we look at the risk. So when you look at right side events, it's important to remember that returns are not sequential. And when we look at models, we often fall into the trap of thinking that returns are sequential. Annualized return will come every year, rain or shine, but they're really lumpy in reality. And so when you look at the positive return bias of US equities over the past, even if you look at 30 years, for example, there's a much stronger positive return bias to negative return bias if you look at a 12-month, rolling return. So in that analysis, you'll find what I'll call lumpy right side or right tail events, big positive years. Then they'll far outnumber by, call it 4 or 5x, the big negative years. So mitigating downside risk is one thing, and it's vastly important. But on the other side of the coin, if you want to maintain the ability to garner those long-term compounded annual returns, you have to try and capture those right tail events, the outsized right tail events. And so the way we've chosen to approach structured outcome is to do it in an uncapped basis. So some of the other products on the street, and again, they're perfectly usable tools in various circumstances. But what we've chosen to focus on is allowing investors to also try and capture that right tail event, which is so necessary to compounded returns. So the uncapped versus capped discussion, I think is one that's pretty relevant between first and second generation approaches in the structured outcome space.
And that's what makes it really interesting, because the natural question is, how is it possible to establish a downside protection without sacrificing the right side, the upside gains that you were talking about?
Right. So you will sacrifice some. There's no free lunch, as we always say. So by establishing the position in a little different manner, it's the same approach. We use a 12-month investment period. You get in on day one, you hold it for 365 days, and you've got what we consider a defined outcome or a predictable outcome. But in this circumstance, what TrueShares does is we actually, instead of establishing a cap, we will give a percentage upside return. So we will never capture 100% of the upside return. The difference between what we call the skew, for those options educated folks that are tuning in, the difference in the skew will never fully allow us to capture 100% of the upside return. But what we've chosen to do is, instead of deploying a hard cap, we choose a percentage of the upside return, and therefore not capping off some of those large outsized right tail events. So if you take, for example, our most recent launch, which was July, you've got a 10% downside buffer in that product, and then an 82 to 84% upside capture ratio. So if you do come across an outsized upside event, you will capture anywhere from 82 to 84% of that upside event if you hold the investment throughout the investment period. And so we think in many cases, historically, that can prove extremely valuable to the long-term investor in their compounded return profile.
All right, Michael, super interesting. Thanks so much for joining us on Trade Talks.
Of course, thanks for having me.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.